Hi everyone, today we're going to talk about flood, earthquake, and specialty forms. Many of these address catastrophic risk exposures. We'll start with a look at the National Flood Insurance Program, or NFIP. The NFIP was established in 1968 and is administered by the Federal Emergency Management Agency, or FEMA, so this is a federal government program. Policies may be serviced by FEMA or through the Write Your Own or WYO program, which was established in 1983. The way this program works is that NFIP actually sets the rate. In other words, rates don't vary by insurer, but insurers service the policies. NFIP also assumes the risk, so when losses are paid, they're actually paid out of the NFIP funds. The vast majority of flood insurance policies is actually written now through the WYO, and in order to obtain an NFIP policy, you would have to go through an agent that participates in the NFIP program. In order to be eligible to purchase flood insurance through the NFIP, you must be in a participating community. This means that the community that you live in has adopted and enforces floodplain management standards. There's a misconception among many people that their community does not participate. Fewer than 10% of communities in the United States do not participate in the NFIP floodplain management standards. And areas where they do not participate are generally extremely rural, so there's not a lot of property in those areas anyway. The NFIP classifies areas with high risks of flooding as Special Flood Hazard Areas, or SFHAs, commonly referred to as flood zone. But to be clear, everyone lives in a flood zone. It's the Special Flood Hazard Areas which have a high risk of flooding as designated by the NFIP. And NFIP readjusts the flood zones and reclassifies them on a fairly regular basis. Firms, which are flood maps, designate the locations of the SFHAs. Federal regulations require federally insured lenders, which are most lenders, to require flood insurance on properties in the SFHAs. So there are many commercial properties especially that are actually required because of the loan on their property to purchase NFIP. The NFIP has two different programs. First is the emergency program, which is for communities in the initial phases. And next is the regular program, which is for communities that have fully implemented the standards. The maximum amount of insurance available depends on whether your community is in the emergency program or the regular program. The emergency program maximum limits are $100,000 per building and $100,000 for contents. With the regular program, the maximum amount you can purchase is $500,000 per building and $500,000 for contents. For residential condo associations, they can purchase up to $250,000 times the number of units. We'll look at that again in a moment. Now let's look at the NFIP General Property Form and the Residential Condo Building Association Policy. First, let's look at a comparison between the NFIP General Property Form versus standard commercial property coverage. There are some key differences between the NFIP and privately purchased insurance for non-flood perils, as shown below. With the NFIP General Property Form, property is valued at actual cash value with no option for replacement cost. There is no co-insurance requirement, and policies cannot be written on a blanket basis. The NFIP General Property Form does not cover loss of use or loss of income. Additionally, the NFIP General Property Form excludes property located in, on, or around water, underground structures, and buildings and contents if 49% of the actual cash value of the property is underground. And finally, the NFIP General Property Form does not include any coverage for property owned by others. By comparison, the Standard Commercial Property Coverage Form offers actual cash value coverage with an option for replacement cost, as you remember. It does have a co-insurance requirement. It can be written on a blanket basis, of course. and it does offer a loss of use and loss of income option. It doesn't exclude property in or around water and does cover most underground property other than pipes, flues, drains, and the like. And of course, it does include coverage for property of others. Now let's look at the NFIP General Property Form versus the NFIP Residential Condominium Building Association Policy. The acronym for this is either RCBAP or REBAP. There are key differences between the two NFIP policies shown below. With the NFIP General Property Form, the maximum limits, as mentioned before, are $500,000 as long as the community is in the regular phase of the program. Only actual cash value coverage is available, and there is no co-insurance penalty. With the REBAP, which is for condominium associations, the maximum is $250,000 times the number of units. Contents is limited to $100,000 per building. The REBAP also offers replacement cost coverage on building property. It does include an 80% co-insurance requirement. If you want to learn more information about the REBAP and a comparison of the REBAP to the other NFIP forms and the standard property form, this is a great source from FEMA. Last in this section, I want to talk about Coverage D of NFIP General Property Form, which is increased cost of compliance. This pays up to $30,000 for activities necessary to comply with a local or state ordinance brought on by a floodplain management ordinance or law affecting repair and reconstruction involving elevation, floodproofing, non-residential, relocation or demolition, or any combination thereof, of a structure after a direct loss caused by a flood as defined by the Standard Flood Insurance Policy, or SFIP. While this is a long definition, I think it's important to be aware of this definition because it likely impacts many coastal businesses that have been or could potentially be impacted by flood. But realize that it isn't just coastal states or coastal property that is impacted by flood. Some of the worst flooding in the country has occurred in states like North Dakota, Tennessee, and Ohio. Now let's look at the ISO Flood Coverage Endorsement. The ISO Flood Coverage Endorsement is available from both standard insurers and, in some cases, non-admitted insurers. For properties that are not in SFHAs, commercial flood insurance is widely available. The definition of flood is essentially the same as that of the NFIP, but the terms and conditions of the policy are different. Let's look at the definition of cause of flood under NFIP and ISO. It is the overflow of inland or tidal waters, unusual and rapid accumulation or runoff of surface waters from any source, and mud flow. Mud flow must be a temporary condition. Therefore, landslide, slope failure, or soil mass liquidity by a slope are not considered mud flows. Let's now look specifically at the ISO flood coverage endorsement. First of all, you must realize that any ISO coverage is excess over NFIP. In other words, in order to obtain the ISO flood coverage endorsement, an insured would first have to purchase insurance through the NFIP. Let's talk about the features of ISO flood coverage. As I just mentioned, the flood coverage endorsement is excess over the maximum NFIP, unless this requirement is waived by the insurer. Typically, this would only apply if the insured wasn't able to obtain NFIP insurance. Let's talk about the deductible in the flood endorsement. The size of the deductible depends on where the property is located. In other words, whether it is located in an SFHA. Deductibles tend to range from $10,000 to $25,000 outside of an SFHA, or can be as high as $100,000 if the property is in an SFHA. There's usually a higher deductible with flood insurance than for other causes of loss. Let's look at a typical scenario. Let's assume that the NFIP limit is $500,000, which is the maximum limit available. The insured purchases an ISO flood endorsement for $1 million. A loss occurs for $750,000. The NFIP will pay the $500,000, ignoring any NFIP deductible. The flood endorsement pays $225,000, which is the excess over the NFIP and the deductible. Let's look at this a little more closely. The deductible over the NFIP for the flood coverage endorsement works sort of like a corridor deductible. The NFIP coverage is $500,000. The deductible is $25,000. This would mean that if a loss occurred for $1,525,000, NFIP would cover $500,000. The insured would have to pick up $25,000, which is the deductible area. And then the flood endorsement would be $1 million of coverage. So looking at our $750,000 loss, the insured would get $500,000 from NFIP, ignoring any NFIP deductible. Again, pay $25,000 out of pocket and receive $225,000 from the flood endorsement. Now let's talk about the difference between NFIP and the ISO flood endorsement. ISO provides coverage for a greater variety of properties. And as already mentioned, NFIP provides no business income or extra expense coverage and no ordinance or law coverage beyond the increased cost of compliance, which was coverage D. These can be added with the ISO flood endorsement. NFIP pays only actual cash value, whereas ISO can be replacement cost. And in general, more property of the insureds is not covered by NFIP. For example, foundations below the lowest basement floor. And more on the limits of NFIP. For properties in special flood hazard areas, reinsurance can be scarce. This is because losses are potentially highly catastrophic. An insured who wants to purchase NFIP must often purchase facultative reinsurance on their own. Facultative reinsurance is a reinsurance policy for that one particular risk, that one building. Also, you can look at pages 6.13 and 6.14 in the text for property not covered by NFIP and not covered by either NFIP or the flood coverage endorsement. Now let's discuss earthquakes. This is kind of a cool map because it shows the location of earthquake events from 1963 to 1998. So as you can see, it affects most of the world, and particularly a great deal of the United States. Let's discuss the ISO earthquake and volcanic eruption endorsements. There are two endorsements to a CPP to add earthquake or volcanic eruption as a covered peril. The CP 1040 does have coinsurance, and the insured must have the same policy limit as the rest of the policy. The CP 1045 has no coinsurance and, therefore, can be written for a sublimit that is less than that for other perils. Neither of the two forms defines the word earthquake. Earthquake insurance tends to be difficult to obtain in states near a fault line. Of course, states in the West, particularly California, are highly susceptible to earthquake, but these states surround the New Madrid Fault, which is located in New Madrid, Missouri, and of course the San Andreas Fault in California. Insurers nearly always reinsure earthquake insurance. Let's look at a loss example. Say a building has an insurable value of $2 million, and coinsurance is 80%. The building is insured for $1.6 million, meaning it meets the coinsurance requirement. A deductible is 5%, or $80,000, 5% times $1.6 million. A loss occurs of $200,000. Payment is $200,000 less $80,000, as simple as that, $120,000. Now let's take a look at differences in conditions. DIC policies are available to fill almost any gaps left by insured's other property insurance. It is commonly used to cover flood and earthquake exposures on a primary or excess basis. DICs are often written for only a percentage of the loss. For example, they might pay only 50%. DICs frequently exclude basic perils such as fire, wind, and hail, so they can be classified as inland marine, which are favorable to insurers because inland marine coverages are typically exempt from state rate and form filing requirements. Most DIC policies are equivalent to the special cause of loss form. So if an insured purchases a basic or broad form cause of loss and needs to add certain perils covered on a specific basis, they can do so with a DIC. DICs don't require coinsurance. This allows insureds to obtain lower limits. Otherwise, coverage for them may not be available or affordable. So this might be the only way they can get coverage, even though the limits are lower. Now let's finally look at specialty policies. These are output policies, highly protected risks, and layered property programs. We've already briefly discussed output policies in the first chapter. These provide broader coverage than standard CPP forms, but do not cover any liability. They generally suspend the coinsurance requirement. These were originally created for manufacturers, but are often used for medium and large agricultural operations and construction. They're very flexible, and they're good for property at unspecified locations. They also provide broad property and transit coverage. There's also specialty policies for highly protected risks. These are generally only for large accounts. Partly, this is because the insurers must provide intensive risk control for a highly protected risk. The rates are typically much lower than they would otherwise be because the insurer is relying on the risk control techniques that the insured is employing. Some insurers actually specialize in providing highly protected risk coverage. For example, FM Global. You can go to their website and check out how they approach and view highly protected risks. The general idea is that there is a focus on risk management to prevent losses before they ever occur. Lastly, we'll talk about layered property programs. These are often necessary when an insured needs high limits of insurance, and these are particularly common in the non-admitted market. Each layer is a separate policy. Frequently, there is more than one insurer assuming a portion or percentage of each layer. If you take Risk Management Insurance 4008, you'll learn a lot about this. These may be admitted or non-admitted. And that's the end of our discussion of flood, earthquake, and specialty forms.